All right, so in this video, I'm going to address a few topics as it relates to the regulation of annuity contracts and a few other factors as well. Generally speaking, the annuity contracts are going to be regulated by state insurance commissioners because they are considered to be kind of under the purview of insurance. And so that means that regulations could vary from state to state, but it's going to be regulated through state insurance commissioners, and states do have um, rules and regulations and some things I'll mention here in a moment as it pertains specifically to insurance companies associated with the state. Now, if you think about a company that is issuing an annuity or selling an annuity product, one of the concerns that would naturally arise would be kind of like with various other forms of insurance, the credit rating of the company issuing the annuity. So that would be something to evaluate is, what is the financial condition of the company that is issuing the annuity? Because there's a company that is standing there and basically making that guarantee of payment. And so we need to find out whether that company is in good financial health or not. Which brings us to sort of the intersection of those prior 2 points, and that is that there are typically state guarantee funds that provide a pool of money to cover a situation in which an insurance company fails. So you have kind of two prongs here. One, generally they're going to be regulated by state insurance commissioners, and then under all that regulation, if the company fails, there is a guarantee fund to kind of cover that and sort of make good on the promises. So you might think, well, then, why do I care about the company credit rating? Well, state guarantee funds may not necessarily cover everything, might vary from state to state. Or what if you run into a situation in which there's a big financial crisis that affects a whole bunch of insurance companies simultaneously? And if that's the case, perhaps the number of failed insurance companies could outstrip the amount of money in the state guarantee fund. So, there's still concerns there. So you still definitely want to make sure that you are evaluating the company credit rating when making a purchase decision. Oftentimes, when an annuity contract is purchased, sometimes there's initial bonus rate where they essentially are paying a higher rate during the initial accumulation period than later, and then it adjusts later. So you have to pay attention to what those rates are now, when they would adjust, how they would be dictated, perhaps due to market changes, et cetera. There are, in some cases, some annuity contracts that have guaranteed minimum withdrawal benefits. They guarantee that you can withdraw a certain minimum amount. However, the rules for that can be pretty complex. And so you have to make sure you know exactly what the rules are and stipulations associated with that, and just how that's calculated, and so forth. So just because it says it as a guaranteed minimum withdrawal, you have to make sure you know all the fine print and what all the details are associated with that. Now, as has been previously discussed in prior videos, there is an accumulation phase, and then there is the annuitization point, where it's converted into the annuity. The timing of that annuitization matters. And specifically, generally, we want to try to avoid annuitizing when rates are low, because that's going to be a factor in what kind of payment they calculate that they're going to give you. So if rates are particularly low, when you convert that lump sum into something that's going to pay you a stream of cash flows, you're basically going to be getting a lower stream of cash flow. So if possible, you want to convert that into an annuity and go through that annuitization process when rates are more reasonable and higher, basically, for you. Which does bring up an interesting point. If somebody is evaluating whether they should annuitize or withdraw, as it was mentioned in the video discussing taxation, if withdrawals are made prior to the annuitization process, the withdrawals are generally going to be considered taxable, because you're going to be withdrawing essentially the gains, because it goes under the last in, first out kind of approach. The gains are viewed as being taken out first at that point. And so that's going to be taxable. So if withdrawals are made, then that's a taxable event. And so that's something that has to be weighed about. Should withdrawals be made, or should we just annuitize this? And it really depends on the financial situation involved. So you have to look at, just how much money does a person need at the moment? Why are they needing money right now? Look at the broader picture. If the person had engaged in an annuity prior to this point, that's why they have this, that they could decide to annuitize or withdraw. That means that there was some kind of planning, hopefully, that went on that led them to think that that made sense in their personal financial plan. So that would have to all be evaluated. You know, what kind of other resources available, what market conditions are going on, why do they need a lump sum of money, and what are the tax implications, what tax bracket are they in right now? You know, all those kinds of things to try to figure out, you know, is it really better to withdraw this, or should or draw some of the money, or should it just be pushed into annuitization and you know, kind of move forward? Um, Now, once you start getting into you know, you annuitize it and things like that in particular, but just sort of in general as well, annuities typically pretty much lack liquidity. So if you're comparing, say, a stock portfolio or stock and bond portfolio, let's say it's a really diversified investment portfolio in a retirement account, generally that's a lot easier for you to make changes and adjustments and shift investments and withdraw, things like that, particularly if you're in retirement. Than an annuity. So once you have annuitized something, you're getting a stable stream of cash flows, but there's not a lot you can do to change it. And so it's you don't have a lot of liquidity there. Whereas some other kinds of, say, retirement accounts, once you're in retirement, you're able to make withdrawals and things like that without triggering penalty taxes. Generally, you have a lot more liquidity. It's a lot easier for you to pull out liquid assets when you want to and make choices. So a lot more flexibility as well. So that's kind of something to contemplate before annuitizing. And that's generally why, in most cases, it would not make sense to annuitize your entire retirement portfolio, because you're just locked in at that point. You really don't have much flexibility. You don't have any choices, and there's really not much you could do if market circumstances change, if your personal financial situation changes. So generally, you don't want to annuitize everything as a result of that lack of flexibility and liquidity. Okay, hopefully this video has been helpful. Thank you for watching, and have a great day.